What's up, guys? Today we're talking about the 5 tips that made me a better yield farmer. So if you've been yield farming, hopefully these tips make you a better yield farmer. Yield farming is a great way to generate passive income with your crypto, but you could also lose a lot of money if you make mistakes. And if you guys are new here, my name is Richard. I'm a yield farmer and investor. And here's a quick portfolio update. You can see I'm still sitting in pretty nice Ethereum profit on my core holdings. I like to use Ethereum to measure profit and loss for a lot of these Ethereum pairs because there will be cases where I'm losing Ethereum here if a certain token is underperforming Ethereum, but the US dollar value of both tokens have been drifting upwards. So I'm still trying to turn around some positions that are in a loss, but these numbers fluctuate pretty wildly here depending on how these underlying tokens perform. Closed position still sits at 8.6 ETH of profit. And then now as the prices move up, I'm starting to focus more and more on stacking some more US dollar profit. Like with this Ethereum and USDC LP here, the goal for this pool is to generate some income as well as to slowly sell my Ethereum on the way up into USDC. So let's dive right into the 5 tips that I want to share with you guys. Hopefully they help you as well. And just a quick disclaimer, none of this is financial advice. I'm not your financial advisor. Please do your own research before making any investment decisions. So the first mistake that I see a ton of people do is they set the ranges simply to be too tight. It doesn't matter which indicator you use. Let's say you want to use the Bollinger Bands or you use the ATR bands. That could give you an indicator of what ranges to set. But a lot of times if you're on the daily chart, chances are your ranges are too tight. You're going to be in range for less than a month before your pools get out of range, and then you're forced to rebalance, and then you lock in a ton of impermanent loss. If I hop to this impermanent loss calculator here, and I deposit in $100,000, if I'm providing liquidity for Ethereum to USDC, for example, and let's say the price right now is around 3,700, I deposit at 3,700. So the price upper, I want to try to have 4,000, and then price lower, let's set it at 3,400. So about $300 on each side here. Pretty tight range, but a lot of people even go tighter than this. But what I want to show you guys is this. We see that Ethereum is at 3,700, right? If you were running this tight range strategy, and Ethereum, let's say, moves up to $5,000, you can see that's a 12 to 13% of impermanent loss that you're suffering. So if you just held whatever assets you deposited, if we go back really quickly here to 3,700, you can see you would have almost 50% Ethereum and 50% USDC, right? And if I move the price now to, again, 5,000, you would see I would have $116,000 compared to barely any capital gains. I have about 102K here if I am in this liquidity pool. So if my APR during that period of time is not higher than 12 to 13%, then I would have been better off just holding my assets, right? And let's say Ethereum goes up even higher to $10,000, which is definitely still very possible. You can see impermanent loss is a whopping 44%. So you would have underperformed holding in the market by 44%. And if you guys don't know what impermanent loss, it basically measures your liquidity pool performance in terms of the liquidity value that's in the LP compared to the HODL value. So this line is the HODL value, right? So at 10K, you would have 181K worth of Ethereum. Capital appreciation, again, once it exits the range, is only 102K if you held your assets, right? And really the worst thing about this is actually the dump to the downside. So if you're actually yield farming very tight ranges at this high price point, and then let's say the price cracks down to $2,000, which is still very possible. We never know what's going to happen in the market, right? If there are some black swan events or bad market conditions that we didn't foresee, then this dump is totally possible. You can see this particular range would have 55,000 on the downside, and then compared to holding, it's only 77,000. This is why a lot of people actually got wrecked. If we look at Ethereum's price here, a lot of people were actually yield farming with fairly tight ranges when the prices were just distributing and just moving sideways around this range towards the end of last year and beginning of this year, right? But then as prices drop, they're actually forced to rebalance down if they want to earn a yield, but their initial capital also decreased by a huge amount simply because they had pretty tight ranges. So that's something to understand. And let me show you guys if we set wider ranges. What I typically like to do is to take a look at the weekly chart here and try to determine where the prices are going to go. So we can see here if we want a more aggressive range, the zone of support might be around these moving averages here where they're kind of moving together, right? The prices have clearly closed above that. So maybe the bottom range could be around 2,500 or 2,300 or $2,000. It depends on how conservative you want to be and which assets you're swapping from. Let's say I want to sell a lot of my Ethereum, then maybe I would set the bottom range should be lower because then I would need to deposit more USDC, right? But for this example, let's say I use 1,300 to all the way at 8,000 here. So price lower is 1,300 and then price upper is at 8,000. At the time of deposit, you can see I would need 40% worth of Ethereum. This is this X number here. And let me adjust it so that it's a little bit more fair. So we have close to 48 and 52 that we saw. So the price upper is around 9,500 here. And what I want to show you guys is this. Let's say we see the price move up to $5,000, right? You would suffer barely any impermanent loss, 2.9% compared to the 14% that we saw earlier. And even at $10,000, the impermanent loss would be higher, but it's still reasonable at 29 something percent. At this endpoint, you could see our portfolio value would rise up to 129K if you were yield farming this pair compared to the 181K. But the advantage is we're earning fees in the meantime, right? And this is still much higher than what we were seeing earlier. Earlier, we only saw 102K of asset appreciation, right? Now let's look at the downside here. Let's say the price now goes all the way to 2,000, only 11 something percent of impermanent loss. Your assets still would sit at 69K compared to holding of 78K and compared to the tight range strategy where you would suffer a lot more losses and your capital would be below 56K. And the current range I'm running is more of a bullish LP where I'm trying to sell my Ethereum and I'm not really optimizing for fee. You can see I set my range at roughly 2,300. My upper range is all the way at $100,000. Realistically, the Ethereum's price is not going to get out of range on the upper side because the range is really, really wide, right? And if it does, I'm very happy as well because I hold some other Ethereum on the side and I would still make a ton of money if Ethereum does pop all the way to $100,000. But what I want to really show you guys is here, if I change the price now to $10,000, what we were looking at, you can see the impermanent loss is only 17.4%. Really, really low while achieving my original goal, which is to dollar cost average out of my position here. And the capital gain is at 194K. So this is a bullish range LP designed to capture the swing upwards. But the main idea is the tighter the range, the less asset appreciation you're going to have, the more impermanent loss you're going to suffer, and then the more drawdown your portfolio is going to suffer if the different pairs you're farming pulls back really hard, right? I've tried both strategies and 80% of the time I prefer a wider range strategy simply because there's much less impermanent loss. I can outperform holding very, very easily. If you guys look at my current positions, if we change this reference value to HODL, you can see I'm up $22,000 compared to holding while earning $28,000 in fees, right? So clearly outperforming impermanent loss very, very easily. There's more asset appreciation when the prices move up. And this is true for crypto to crypto pools as well, right? You can see this Bonk and Ethereum pool that I'm currently in. I'm suffering this positive divergence loss here, meaning that I gained this amount of ETH just based on the initial asset that I put in. So much, much more capital appreciation. And I don't have to worry about going out of range all the time, right? So it's very, very passive. It takes me less than 1 to 2 hours a month to run simulations on my portfolio, to track my portfolio, and also manage more than 10 positions. So in my opinion, wide range strategies are much, much better, especially if you guys are yield farming very volatile pairs like Ethereum to USDC or altcoin to Ethereum pairs. And the second tip that have helped me a lot is to only yield farm assets that we have conviction in. For example, I believe in Bonk as a project. I think it's doing really great. They have a lot of different products like the Bonk trading bot on Telegram, as well as their token launchpad, which is doing really well. So it's a great project based on my own research. And again, you want to do your own research. Your conviction on different tokens might be different. But the reason why we need to have conviction on the tokens that we are yield farming is because we do see really sharp drawdowns from time to time, right? If we look at the US dollar value of Bonk, you can see it lost like 85% of its value, right? Before it actually moves back higher. And it's still down about 45% from its all-time high. But it's not a big deal if I have conviction in the project, right? Because if I do know that the fundamentals behind the project is solid, and this is potentially something that people would speculate on, then I actually will shift into accumulation mode when the prices are cheap, right? And then I take profits again when the prices are more expensive. But if you have no conviction in the token that you're yield farming, a lot of times when the prices crash and there's a lot of fear in the market, you could be selling out of your positions for a loss, even though the whole dump might have been just market driven, right? It's not driven by any fundamentals that are specific to the project. And in my opinion, yield farming is the best at accumulating assets that you're bullish on for the next at least 6 to 12 months. It's not really for day trading or trading assets that you want to sell like, 24 hours or 48 hours from the time you buy, like smaller cap meme coins. And it's not really an optimal strategy if you want to exit your position in like 1 to 2 months as well. In a lot of those cases, you might as well just be trading those tokens and not have to worry about stuff like impermanent loss. And the reality is that your thesis could take years to play out, right? If you don't believe in Ethereum, for example, then you don't really want to yield farm Ethereum and accumulate Ethereum. If you guys look at my portfolio here, you can see that the fees that we're earning are the tokens that we're depositing into the pools, right? For example, Bonk to Ethereum, Pendle to Ethereum. If I'm not willing to hold these tokens, then why are we accumulating those assets in the first place if we don't believe that they're going to go up over time? Again, it could take years for your thesis to play out. For example, from last cycle, Ethereum was trading at $5,000, and now it seems like it's swinging back upwards, potentially breaking through its all-time high here. But it took years for Ethereum to recover in price, which leads to my next point is that we want to be able to think in multiple time frames, but mainly the middle to longer time frames, because a lot of people actually have like a shorter term thinking. That's where all the range chasing and all the tight range strategies come from. They really want to make like a ton of returns in like a month or two, right? But really, we should be thinking in terms of at least 6 to 12 months if we're yield farming most altcoin pairs, and if we're yield farming a lot of blue chip assets. A lot of times we're trying to accumulate these assets for the next 3 to 4 years or even 10 to 20 years. So it really helps to think long term and think in mid to short terms as well. Stuff like Bonk and Ethereum, even though I'm bullish on Bonk, if the price moves up pretty aggressively during altcoin season, then I will be selling my Bonk pretty heavily, right? I'm not going to ride my back up and then not take profits and ride it all the way down just because I have conviction in the token. So we do need to realize some short-term gains and then maybe rotate those profits into longer-term assets like Ethereum, Bitcoin, and the stock market that are going to likely be around for the next 10 to 20 years, right? That's how we could generate a ton of return, making sure that we're taking profits aggressively if those opportunities come, which is my fourth tip here, which is to take profits or watch it melt away. If we look at the others chart, which is the total crypto market cap, excluding the top 10 crypto, so mostly altcoins here. And what we would see is that sometimes prices do go up by quite a lot from, let's say, 190 billion here all the way to 400 something billion, right? So 139% increase. If you didn't take any profits, you basically saw another 60% drawdown from its high, retracing most of this gain here, and you would have missed out on a lot of profits that you could have taken, right? So there could be a great opportunity to take more profits once again, especially if this others chart break higher here into a higher zone, potentially even $1 trillion here. That's a really great target to secure a ton of profits because we don't really want to ride a lot of our profits into the bear market, right? If you guys see like the previous drawdown from the peak to the low, that's an 85% drawdown. So let's say you started with 100K this cycle, right? You were able to do a 10x on your portfolio. It's $1 million. You're euphoric. You're really happy. But because you didn't secure enough profits on the way up, and then you're still basically chasing new gains, even though you've actually made a lot of money. Let's say the market draws down by 85%. We just saw that it's very possible, right? Multiply that by 0.15. You would see that your portfolio would drop all the way back down to $150,000. And that's assuming that you got a 10x multiple on your capital in the first place. So very important to be securing your profits. One easy way that I like to do is just to sell a lot of my assets that I'm yield farming into either Ethereum, Bitcoin, or stablecoin. And because Ethereum's price have been moving up pretty aggressively, I personally will be selling a lot of my fees at the end of the month into stablecoins so that if there are drawdowns in the future, I could take advantage of that, or I could yield farm with those stablecoins to generate a yield on my assets as well. And we could always exit our position entirely as well, right? With the Bonk and Ethereum pool that I just showed you guys. If Bonk does another 3x from here or a 4x, and then Ethereum also does a 2x from here, I would most likely consider very carefully if I want to exit that position into stablecoin or into Ethereum so that I could prepare for the bear market as well. And the last tip before I hop off here is to always think for yourself. Just because you hear something very often or from an authority figure or someone very popular doesn't make it true, right? A lot of people were saying, Ethereum is dead. Ethereum is never going to make a comeback. It broke like a key zone of support at $2,000, right? Solana is the future and whatever. But now we see Ethereum ripping back up close to its local high and potentially retesting its all-time high fairly shortly here. So what you hear online is often wrong, especially with yield farming as well. One example of a common misconception in yield farming is that impermanent loss is bad and it's just very hard to beat, right? You guys can see with my pool, I'm beating impermanent loss fairly easily. If we change like the HODL value for a lot of these pools, they're able to actually beat impermanent loss with some exception here where I'm still sitting in a loss compared to holding. But over time, I would still be able to beat it if I stay in range for a long time and just think long term. And impermanent loss could actually be a good or a bad thing as well, right? I've said multiple times on my channel, when we suffer a positive divergence loss, meaning that if I'm looking at the Bonk to ETH chart here, and I deposit it at a price that's like below its current price, so I actually started yield farming in this pool at 0.00006, and now it's at 0.00087. So I'm actually gaining a net Ethereum on my capital as the price drifts upward because whatever Bonk that I invested in this pool, you can see this amount of Bonk here actually is getting sold more and more into Ethereum, right? And you can see the log here. I started with 5.36 Ethereum. Now my LP value is worth 6.59 Ethereum with no additional capital while earning some really nice fees. And I'm not even compounding all of my fees, right? And I hear people in DeFi all the time say that, yield farming concentrated pools is not worth it because of impermanent loss, just because they misunderstand like the fundamentals of impermanent loss and what it actually means. If you guys really think about it very carefully, we could actually use impermanent loss in our advantage, right? Because a lot of times when these altcoins move up in price, I actually do want to sell my high risk assets like Bonk into like lower risk assets like Ethereum. And again, it's fairly simple to outperform holding here. The fee APR on the HODL asset is 69%. And it doesn't matter how you slice and dice it, your impermanent loss will never be greater than 100%. So if I simply stay in range for 2 years here, and the fee APR stays roughly the same, I would outperform holding 100% of the time, right? That's just one simple example of beating impermanent loss and how it's just a very misunderstood topic that actually deter a ton of people away from yield farming concentrated pools, right? And it's great for us as well because, there's just less competition in the market. But hopefully, if you guys see this video, it's actually really good to yield farm concentrated pools. That's how I've been able to make a ton of gains this cycle without actually having to, perfectly time the market, which you really can't. And another example of a very misunderstood topic is actually correlation. I will probably make another video on this, and it doesn't matter which correlation tool you use. For example, this is the DeFi Llama correlation tool. So let me pull up Bonk here. What I want to show you guys is that just because an asset is not correlated doesn't mean that you should not be yield farming it. And a lot of times assets break correlation all the time. Correlation basically measures if the asset is moving together or not. So if Bitcoin is moving up and Ethereum is moving up, it means that they're positively correlated, right? But if Bitcoin move up and then Ethereum tends to trend down, then you would see a negative correlation. But the reason why I don't like to use correlation at all is, let's say Bitcoin and Ethereum currently is very highly correlated, right? But over 1 year span is only 0.27. If you guys actually search for older videos on my channel, the number was actually lower at 0.15 or lower. And actually during the period of last year, we were seeing a higher correlation at higher than 0.5 for the 1 year period. So does that mean that we should not be yield farming Bitcoin and Ethereum? My personal answer is no. If these two assets, even though they're not correlated with each other, are assets that you want to hold long term, it doesn't actually matter if they move together or not. The reality is more than 80 to 90% of altcoins actually do have correlation with stuff like Ethereum and Bitcoin. And the thing is, we never know when the correlation is going to break. So for example, in this period, the correlation is higher between Ethereum and Bitcoin, but actually the pair is quite volatile. So it doesn't really show us how much impermanent loss we're minimizing by yield farming this pair either. The correlation number actually doesn't show how much the pair move together, right? So if Bitcoin goes up by 1%, but Ethereum goes up by 10%, just because they're moving up together, they're actually positively correlated, but you're still going to be suffering impermanent loss because Ethereum is outpacing Bitcoin by a large amount, right? Which is what we saw in the last couple of weeks here. So correlation is really not that reliable, but a ton of people still use it. Even though correlation doesn't really help you that much, what I like to use instead is relative strength. For example, if I'm yield farming Bonk and Ethereum, a lot of times I'm trying to bet on the outperformance of Bonk. This green line is my entry here on the Bonk to Ethereum chart. Again, as the prices are staying above my entry, I would actually suffer a positive divergence loss, meaning that I would have more Ethereum than what I started out with, which is really great here. And I could just chill in this zone and then just keep selling my fees for an Ethereum profit while taking very little risk, right? You could see based on my entry, the prices don't tend to stay down here very long at all. And if they do, that's actually the best opportunity to compound my fees and drag down my entry. And then when the prices rip higher, I could choose to exit my position completely as well, or just keep milking the fees and just keep selling the fees. But the idea for this tip is you always want to think for yourself. Just because I say that, impermanent loss is not that crucial if you know how to beat it, or that correlation is not that good, it doesn't mean that those are facts, right? Those are just my opinions. You want to be able to think critically for yourself. Why am I saying this? And are those reasons valid based on your own experiences and just logical thinking, right? A lot of people just take things at face value, never actually thinking through the whole process and the principles behind it. We want to think about the principles behind the concepts and the strategies so that we actually deeply understand the topic. So those are the 5 tips I have for you guys today. Hopefully it was helpful. The first one is to be sure to set wider ranges if you want more capital appreciation. less losses and less impermanent loss. The second is to only yield farm assets you have conviction in and want to accumulate because you believe that the prices would move higher. The third is to be able to think in multiple time frames. We want to think long term as well as short and mid term, and depending on who you are and your temperament, maybe you're already a long term thinker. It could benefit you to think a little bit in the short term as well to make sure you're securing profits regularly. But if you're a short term thinker, then it helps to think longer term and make sure you're accumulating longer term investment assets. The fourth is make sure you take profits when the prices are good. The crypto market is very volatile and you can just see your gains melt away in a couple months, right? So taking profits is very important. And lastly, always think for yourself. Even things that I say, I'm not right 100% of the time. I'm still learning every single day. And those are the 5 tips. And if you guys found it helpful, then be sure to check out the other videos on my channel. I try my best to give you the most value when it comes to yield farming and investing. So hopefully you can make more consistent profits. Thanks for watching. I'll catch you guys next time.